Welcome to this episode number 45 of your next trade called today Smart Bonds versus Dumb Stocks. So first thing first, if you like what you see today, please subscribe to the channel or put a like or a comments. That will help going forward. So as we have been underlining for the last few weeks, the market has been very much driven by bonds. And if you have been trading the market, you do know, especially if you're in a stock trader, that the bond traders have been supposed to be the smart traders. So the smart people in any market. And actually over the last 24 months, you can see that actually those smart people have not been that smart. So me, mostly trading stocks, as I've been saying in the recent month, it has been quite funny to see all those bond traders saying, we are the smart people and trying to catch the bottom. And the bottom we had for this week, and we had a violent move on the way up for most assets. So here we are looking at the correlation in blue between the S&P futures and the 10 years futures. And as you can see, the correlation has been very strong. So overall, the market has been looking at one thing only, which has been the bond market. And more specifically, starting with the US 10 years, the 5 years, the 2 years. So if we start with the US 10 years, we had a big move from 4.30% to 5%. But what has been happening for this week is we went from 5% or 4.95 on Thanksgiving to 4.50 at the close as of yesterday. What are the reasons? Many reasons. So the first one has been positioning. So when you have positioning, which is one-way traffic, when we had the Palestine and Israel conflict, when we had the slowdown of the economy, a lot of positioning was short bonds, which was created by the fear of more inflation and the central banks being higher for longer. One of the second thing is when you have a lot of supply coming into the bond market, as we have seen recently, if we have a change of expectation in the supply coming from the US Treasury, which was announced midweek, saying we're going to have less long term of the curve and more T-bills that will be supplied to the market, that helps the overall 5, 10 years, 30 years. That was one of the reason. Another one is if you have a big guy like Druckenmiller saying, I'm now long bonds, I'm long the 2 years, long the 10 years, because I think we reached the bottom in bonds and the economy will be slowing. You have different factors. And you add up on all of this, the NFPs as so the job yesterday that was not that great or below expectations, meaning some market participants are saying, the Fed is down, probably this is the peak rate. You have a massive move in the bond market. So bond market has been in a bear market for the last couple of years. As I've been saying, the bond traders, funny enough, the people on Twitter will have, 50,000, 100,000, 150, 200. I've been telling you to be buying bonds when it was at 420, 450, 5%. So if you've been buying at 450, in between it went from 450 to 5% on the 10 years. So that means to get a one-to-one risk reward, you need bonds to go back to 4. Similarly, if you've been at 420, you are way off mark. So what it creates three types of trades. If you've been right for this week, you have been making very good money. So that means if you've been long the equity market, long the bonds from the start, you've been making good money. Okay, and we are talking people that entered the market or at the start of this week. If you've been short, obviously you've been destroyed. And if like me, you just came back from holidays, you've been spending some good time in New York, you are been standing on the sideline and you might get frustrated. Okay, so that creates on most traders, and starting first with the retail traders, that creates some mental issues. Maybe it's a big word, but that creates FOMO. So we are now in the space where we got 2 months until the end of the year. The FOMO is very, very strong already. We've seen over the last couple of weeks, so the stocks that moved the most on the way up were the most shorted stocks. So be careful. You don't need to be always in the market. You need to follow your process and you need to have strong risk management. So finally, the smart bond traders can say that they are very smart, But, trading stocks, you can argue that, again, for the last couple of years, it has been a struggle for those smart people. So let's look at this week. What a week. Starting with equities, as always, with stocks. S&P 500 up 5.9%. Nasdaq 6.6%, and the Russell finally, small and mid cap 7.6%. So you had a change. So the underperformers before, as long as a week ago, completely turned and outperformed the market. And overall, you can see anything that is in blue, that the overall market was pretty strong. When you have a risk on, that means most of the time that US dollar will be weakening. That is explained as well with the bonds being very strong and the yields coming down. So the carry is not helping the US dollar. Finally, interestingly, you see the WTI oil down 6% on the week. So actually, XLE, the big majors, oil majors, very weak on Friday. We need to see, if there is any follow up. That is explained as well by the less focus from the market on Israel and Palestine. How long can it last? That is always the question. So now let's look at the week-to-date industry performance. And you always need to check what is the quality of the things that have been moving. So if we start with the S&P, which is here, you see that you have those big outperformers. What are they? Regional banks, home builders, social media, solar. So some of the sectors industry that clearly have been underperforming the market. So the ones that have been shorted mostly have been outperforming. Does that mean that this rally has been high quality? Obviously not. What you need to put into perspective is before, let's say at the end of September, the market on the S&P was roughly around 4,400. Then we dived about another 5% on the Palestine, Israel. We looked at as well at the economy slowing. So market was a bit on a risk off, trying to reduce gross exposure. And the sectors that are now bouncing are the sectors that were the most punished. So that is the same here. If we look at the week-to-date sector performance, that is clearly a risk-on week where we get the defensive sectors like healthcare, consumer staples that are underperforming the overall market, which will be here, the S&P. And as yields are coming down, real estate has been really strong. And you can see that the usual suspect, the IT, consumer discretionary, actually, the financials, it's mostly based on the sell-off that we had before. But if we think that the economy is slowing, and actually if we think that the yields will be going lower in the long run, this is not necessarily a good thing for the banking sector. So let's look at bond, because as we have been saying over the last few months, clearly all assets have been following the bond market. And starting with the US 10 years, so we are, as of yesterday, at 4.57%. We are down 30 bips, 25 bips on the week, so that's pretty significant. And that is true across developed market except Japan, because the Bank of Japan made this announcement that they might be a bit tweaking their policy and are fine with the Japanese 10 years going up to 1%, sorry. But overall, you see this move in the 10 years. So 450, we are back to the level that we had at the end of September. What has been moving the most is the long end of the curve, so not the short end of the curve. So the duration part, the 10 years, has been moving on the expectation that the Fed will be less aggressive. And as I said, some over positioning, some comments from Druckenmiller on the economy going forward. So what about the FOMC? So we had the FOMC, the Fed, on Wednesday, so it was unchanged. The comments were seen from some market participants that the Fed is done and the hiking cycle. So let's see at what we have as of yesterday. So Fed fund rate at 5.33%. If you look at the peak rate, we are talking roughly 5.36%, which is here. So in other words, market participants are saying this is a done deal. The Fed is not going to do more. What about the 533 versus the June? So you can see in June 504. So that means now market is expecting the Fed to be cutting rates by 25 bips at least in the first 6 months of 2024. And if you compare that with December 2024, you're gonna have a differential of 90 bips roughly, so 3 to 3.5 cut of 25 bips. And you can see as well the change from the blue line to the or to say the red line to the blue line. Everything has been coming down. So, and that is as of comparing as of Friday a week before. So market is pricing the Fed to be cutting more rates. The peaking cycle is done. So overall, that means risk off. As always, over the last 18 months, market has been trying to price when is the Fed will be down, when will the Fed pivot, and going forward, as we're going to see, there are not many catalysts in terms of inflation except the CPI that will be in 10 days time. So what about the VIX? The VIX is exactly the same story. When you get a risk-on story, VIX is going down very quickly. So week to date, we went from 21% plus to 15% and below. So that means 15% and below. That means now market thinks that the S&P will be moving by less than 1% every single day. But you see this big change here. And what is interesting is two things. I put here, so be using the VIXCentral.com if you want to be looking at the VIX structure. So I use the October 31 and the October 17. So October 31 is obviously as of last Friday. And as you can see, everything has been moving down. So we went from 18% to 15, 16% on the VIX. So we lost 2%. And if you look at the October, actually the October 17, which was before the market, before the S&P sold off, that was more or less the same level. So what happened is actually S&P is roughly at the same level that it was before selling off, but volatility, instead of being at 16, 17, 18%, is now into the 14, 15%. And what is it? Why is it? Is, as we do know, as we underline, it has been very hard for investors to hedge themselves. So they have been, in a way, overbidding or paying a bit too much for protection through the VIX. They have been overbidding the gold. The reason was they could not be hedging themselves with the bonds. Now going forward, what's going to be very interesting is to see if actually the correlation between the equity between bonds and any assets will be changing a bit. Because if that's the case, actually we could start to see bonds being bid and the equity market coming down, or similarly with the VIX. So that is one of the trades that I'll be looking, starting with the S&P futures, and I'm using the Bloomberg because the data are a bit better. But what I want to flag first thing first is we do know that we had something that we discussed, the 4200 level that was important. And you see this, we overshoot into the 4150, and as you can see at the bottom here, you see what is very important in technical analysis is just not to be putting lines, but to be putting those lines with some volume. So you get the volumes from the volume profile, you get the volume on the day here, and as you can see, there is a strong move way above the moving average, let's say, of 20 days, and we had a change in the overall market in terms of positioning. What about the same with the Nasdaq? Nasdaq, it is kind of a flag. I don't know if that's the flag. I don't know what you call that exactly. I'm not very good. But overall, we do have on the Nasdaq 1 to 2% upside before we might have some resistance. What about the Russell? Russell, the big underperformer. strong 2 candles over the last 2 days. If you think about it, we are talking 100 points, which is 6% in a couple of days. Why? Because all the losers of the past have been outperforming the overall market. Now, let's look at the Russell versus the Nasdaq. It's the same as we had over the last 3 weeks or so. The leaders of this world, looking at the FANG versus the S&P, actually over the last 3-5 months, they have not been outperforming the market. So the struggle going forward, as always, will be to find the new leaders, the stocks that might pull the market higher, and that has been pretty hard. The market is not trading sideways because we have been trading in a big range, but we have not been finding some new leaders. What about oil? Oil, as long as the tensions are coming down a bit, and I don't know if they are coming down, but oil, I don't have much of a view these days between the supply and demand and what is happening in the Middle East, so I'm not trading it. If you look at copper is telling me that the world is not doing very, very well because this is a question of supply and demand. Gold 2000, not much of a view. I think it was, and the view was, it was hard to hedge yourself. So gold has been finally doing the job of the hedge. Euro dollar, so similar to any assets, as I said, if we have been putting some risk again, as the 10 years have been coming down, euro has been benefiting. Same with the yen. And looking now at stocks, so JP Morgan, this is a stock that I like to be monitoring to see going forward. So I don't like this chart that tells me that nothing is good. Apple. So far, we are still in the downtrend, and actually you can identify some levels if you want to be trading it. And I'm looking obviously at some of the next drivers, which will be NVIDIA. So NVIDIA will be coming on the 21st, so that will be Tuesday after the close. All of you are probably identified this head and shoulder, and when you get head and shoulders with volume, that means most of the time is not going to be working. And finally, looking at Europe with the DAX, I think the DAX is still underperforming, is still struggling, so I'm not that bullish. So going into what we had for the week, starting with always the same story, which is looking at the S&P's chart. You see the trend. So we started the week a bit squeezy. So I came back from New York on last weekend, looking at the market Monday and Tuesday. It feels very squeezy, to not feel very squeezy, but feel a bit squeezy. And if you ask me, I didn't put any position, but I went from being very short. I cut the short a couple of weeks ago. And I'm not going to be trading in easy and some back trading in hindsight. But really the positioning was extreme. When I was aware, you could see that we started to stabilize. Why? As I said, less bond supply coming from the Treasury. We get the FOMC meeting was on Wednesday. So you see this move up where actually over the last 10 FOMC meeting, the market perception was not that great. And for that time, market decided, Fed is down, this is peak rate, we're not going to have any moves going forward. So we get the volatility crash, we get the bonds bid, and finally on the Friday we get the NFP numbers, so the job data from the US, where we had 150,000 job creation instead of 180. So that was another plus for the long people, where you have bad news is good news for the market. As always, bad news is good news, can reach its limits very quickly. And why is it so? I'm looking at the earnings. So starting here with the US, and there, this is for Europe. So I've been using a tool from Bloomberg, and if you look at so this is the per quarter. In blue, you will have here the bids going from earnings. So you see the bids from the earnings in the US over the last 3 quarters have been pretty strong, but you see the trend in the orange one, which is the sales. It's even worse in Europe, where actually the bids from earnings are close to nowhere and actually are down, and the bids from sales have been negative. So in the long run, if you've been doing the 4x4 videos, if you've been doing the mentoring, my convictions that if sales are not going up, if you're not beating the sales, it's not a good omen, and you will see the market coming down. The reason is you can be massaging the EPS, you can be playing with the earnings, you can't be with the sales, and that means overall that the US consumer, that the European consumer, that the world consumer is a bit struggling. So that's really something to monitor. And going forward, what is it we're going to be looking at? The manufacturing PMIs, and as you can see, Europe is coming down and all the other part of the world are trading sideways. So we don't have that much of a drivers, but some part of the world have been slowing. That is true for China. We get some bad PMIs both in manufacturing and services. US, both the manufacturing and services were below expectations. We are in contraction in manufacturing and we are getting closer to contraction for the services. So this is for the economy going forward with earnings that have not been that great. As an investor, as we're in November, you are obviously looking at what's going to happen in 2024 and the valuation of 2024. So what about the catalysts? So we had a very busy week. What about the week going forward? The first thing that you like to be looking at is the bond market, because the market is driven by bonds, and we had two bond auctions. We got one on Wednesday and one on Thursday, 40 billion on 10 years and 24 billion. We do know that the Treasury has been reducing the long part of the curve because the supply is not met that much by strong demand. So to make the market more healthy, they switch some of the long end of the curve into short term, which is the T-bill. But that is really something. So that will be for those 2 days, 6 p.m. UK. What else do we have? We have Powell, which will be coming on Thursday, and that's important because the blackout period from the FOMC, from the Fed, is over. So we need to be monitoring what are the Fed speakers going to be saying. In terms of earnings, it's almost over in the US. We get some names that are coming, 31 names for the S&P, which makes 3% of the market value. One of the few names that we're going to be looking, like Disney and some others. But if you think about artificial intelligence, if you think about potential squeeze into year end, you're probably looking at Nvidia, as I said, which will be on the 21st of November. So quite a long way forward. We got the Australian rate decision on Tuesday. 25 bips is expected. In terms of volatility, expectations 1.3%. So we went from 2% and above to 1.3%. So not much of a driver. Going forward, we got the CPI in 10 days. So as I said, that is on Tuesday the 14th. In between, we don't have much. That explains a lot why the volatility crashed, that we are at 15%. So I'm looking at two things. I'm looking at many things, but just to give you a bit of a trade to be looking at, I'm interested first at not the earnings, but what is the quality of the stocks that have been moving. So this is here. And as you can see, most of the stories that have been on the way up have been the dodgy stories. So we are talking at non-profitable tech, 15%, liquid most short, 12.5%. If you look at ARK, the ETF, it's up, I think, 17%. So it's mostly a reversion to the mean, let's say, or extreme selling that we had until mid-October. As always, when you have names like CVNA and some others that are outperforming and very strong, so we are talking these names here. So if we look at CVNA, up 13% in 5 days, you have all those names with the biggest short interest, up 20% plus, really, really big moves. That doesn't tell you much about that the market is moving on high quality. It's mostly about positioning. For the time being, we got a big move. I don't think the FOMO has been hitting the market yet. So we didn't have, the VIX going into the 13%, everyone buying. So you're still going to have some margins on the way up, keeping in mind that the market is less liquid and less busy as usual, especially going into Thanksgiving. So Thanksgiving is in is in November. Very much, the week of Thanksgiving is very quiet, and then the market starts to get a bit more busy between Thanksgiving and the option expiry in December. But going forward, we don't have much catalyst, so that explains as well why the volatility was crushed. So going forward, what is the trade? The trade is you need to be targeting bonds and seeing, how the bonds are trading. I think we might start to see a decorrelation between bonds and the other asset classes. Something that we had a strong correlation over the last 2 years. So to me, that's going to be interesting because that means the drivers will be changing. And I'm interested at looking, first thing first, how the dodgy names, the short interested, the sectors, the industry that have been hit will be and how will be doing in the next few days, starting from Monday onwards. So this is it for me today. If you get questions on the 4x4 video series and the mentoring, there is a lot of people coming into the mentoring in January. So if you are interested, please reach me very quickly because the space is limited. Please join us on the trading community on Discord. And finally, if you got any questions, you can send me an email or reach me on social media. This is it for me today. As always, be careful with the FOMO after such a big move. You need to have a process and you need to stick with strong risk management. Talk to you next week. Bye-bye.